All right. Well, thanks everybody for joining us. It's been a while since our last meeting, but things changed obviously as far as interest rates are concerned. So that's going to play in the mind of a lot of people, especially as far as qualifying is concerned. It'll pose some challenges. So the program I know that I've been speaking with Deb with and some of you guys is the total net worth program, because it might be a program that might be more popular for some applicants who don't have the income, or because the prices increase so much, you may need a little bit of net worth to help them qualify. Same idea with the Business for Self Plus. I'm not sure if I'll have time to touch base on both of them in great detail, but the first one is definitely the total net worth lending. I think everybody should have got an email from me today with those two programs. What I did is I went into my manual and I cut and pasted obviously the highlights of the program without getting too much into the policy detail. The total net lending program obviously is for clients who have the assets and liquidity, to be able to afford a mortgage payment because their income drawing is low. Mostly you see pensioners or people who are self-employed tend to use this program more than everybody else. The changes you can see sort of like highlighted in orange on the under general description, see eligible applicants. That's new. The minimum income is $12,000 annually, which I think most of your clients at least earn. I don't think I've done too many net worth programs where they use that, but that's pretty much the new idea. The trickiest part about this whole program is you don't know what net worth is required until I'm done my adjudication. It's one of those things where we use what's called the MAMA calculator, the maximum mortgage amount calculator. And what it does is it takes the applicant's income, the mortgage amount requested, the annual TFSR amount, and what it does is, and then takes the TFSR. Let's pretend the TFSR is 85%, and you need a mortgage of $700,000. Well, for sure you're going to have at least 700 net worth, if you want to borrow that much money if the TFSR is really high. So that number is sort of, but if you have an applicant and they have like $3 or $4 million or $5 million, that's not going to be a problem. It's the ones that they got about the mortgage amount in assets that we can use. Will they or will not make it? So those are the ones that you need to be 100% sure what the ratios are when I get the deal. So let's just say that they're buying a secondary home, vacation home. So I need all their income, everything. So that obviously, which is standard, especially if they're self-employed or pensioners. I highly recommend to you in general, so if you have multiple sources of income. And the thing about this program is we have to take income out if we use asset. For example, if we have investment income, but we need their asset that we can't use that income in there. But like I said, for high net worth clients, that's not going to be a problem. We're talking about the borderlines here, the ones where you're not sure if they're quite going to make good or not. And because the program offers no wiggle room, there's no exceptions. It is what it is. There's zero. Our risk department has no exceptions on this program, so it has to be pretty tight. So finding out what the ratios are. So if you're buying a secondary home, I'll not only do I need their income, but I'll need the property tax assessment on the home that they own and stuff like that along with it. Because once I get all those numbers, then I put it into the calculator, and that's when I advise the broker. I think this is what we have. I think they should have enough, and I'm going to send it off to my risk department, or they may not need no on a stronger deal. Obviously, credit has to be pretty solid, on an application like this. So pretty much, you can purchase, refinance, switch with additional funds, principal residence, rental, secondary home, vacation homes. So it's open to a lot of programs. This has probably been, I don't do a lot of them, but I'm doing more than I used to. So you can tell it's getting a little bit more popular. So the second you look at someone's income and the mortgage amount that they're looking at, okay, we're going to see, I have to beef this up somehow. And that's when you get into it. The assets, and that's why I kind of spelled it out here. And I wanted you guys to see that, how we break it down, because you're not going to see too much of this on our website. We have a lot of stuff on our website that you'll see here, but there's little details that you may or may not be aware of that are eligible. Like, for example, under liquid assets, the liquid assets must cover a minimum of 1-to-1 for the increased loan amount over the amount supported by verified income. So you can see where that's going to get a little, it seems a little convoluted, when you see that. And that's why it's important for me to communicate with you guys what, the what TDSR are working at and what net worths are required. Eligible liquid assets, they're pretty good. You have lots. You got savings bonds, checking, savings accounts, equity in existing property being sold, because that's the only time where you see a non-liquid asset is when someone's selling the home. So if you're going to get you're selling it for $2 million and you only need a $400,000 mortgage, well, there's equity from that sale that's going to cover not only the down payment, but the total net worth required. Remember, the down payment, total net worth required are exclusive of each other. It's over and above. You can't say, well, I have 500 grand, but I'm putting 500 grand down. Well, that offsets that, and that kind of kills that part of the net worth. The one that I think I had with Deb, the asset was, all of it was held in holding companies. And there was an impressive amount of money in those holding companies. And I thought it was a done deal, that this is fine. I got the holding company, I got the articles, and it was deemed not eligible because there's multiple shareholders within that holding company. So it wasn't your typical holding company where they could just go and grab money and use it at their will. Everybody on that holding company should be on the deal, which could be a colossal pain in the butt. If there's 5 or 6 people, they're not all going to want to go on a purchase. That doesn't make sense for them to do that, right? It's only, so just keep your eyeballs out for that holding companies. You get the articles. If the 2 owners are on there, and for example, the transactions or business dealings limited to activities within Canada, right? And any assets are liquid and aligned with the list of eligible liquid assets. So of course you'll need their banking statements like was provided the last time I got the deal. All owners of home company, of course, must be on the app. Assets held in the home company must be 100% owners of the holdco. Now you see RIPs and RSPs. You can see that we deduct that, obviously, from the qualification at 30%. We don't want to make it look like we're, having to take people money. They have to prove that they can take a withholding tax and still have enough money left over. Those are popular ones as well, because a lot of people have money in RIF or RRSP. So that's pretty good to know that. Segregated funds, guaranteed investment funds, stocks in Canadian companies, of course, stocks in publicly traded companies, TFSA, US government T-bills, treasury notes, stuff like that. Stuff that can be traced all back here. Ineligible assets, of course, cryptos, currency, equity in real estate that will be continued to be owned. So of course, if they have a rental or something like that, you can't use that equity now because it's still ongoing. Foreign assets, except those expressly stated on an eligible asset list. But yeah, you don't see that too much. Locked in accounts, of course, liras, they're not cashable. They're pensions, locked in pensions. Margin account, that's a biggie, because you'll see that, hey, they got tons of money, and all of a sudden, well, there's a margin account on it. But it's funny with people with high net worth, they tend not to have too many loans against that. So some of them will take them out of a margin account and put in a regular account if they're not borrowing anymore for it or not using it for its purpose. RESPs, that's a big one. You don't want people taking any school funds out to qualify for that, but you're not going to see that. Doesn't come up very often at all. It's pretty, I want to say pretty straightforward in regards to the assets offset the liability, type of thing. But I guess what we want to get in the next phase is, anybody have any specific questions about this program?
What about a trust? What about trust monies that are designated for that particular individual?
That's actually a good question. Did I see something come up in regards to that? Let me check my emails. Because some BRMs, the good thing I like about the BRMs is we have lots of experience, but there's still a lot of questions. And so what they'll do is they'll send emails saying, listen, does everybody have this scenario? And I always like to keep that handy. So where did it go? It's not there. I think trusts come up. Total net worth.
Well, I would think in theory that the trust itself are assets that are generating income. So it's either an income that you have belief that's going to be continuing,
that's
or
right.
It's not. The asset itself is not touchable because it's in a trust. So, would it be deemed liquid? I suspect not.
I suspect so also, because if it can't be touched, because it's sitting in a trust, then the difference. Yeah, you gotta, those are managed and they're very, very sensitive, to withdraw from them as well. It can get pretty crazy depending what the trust and where it come from as well. So yeah, it's most likely not. It would say there on that list that it was.
So if that's treated as investment income as a description, then is that income that you can use, or can you only use it if it's been taxed, shown up on a tax return? Or
That's right. Anything used for income, like an investment account, that income has to be backed out, and that's the only time it could really affect the net worth. Is if you got to back that out, then the TDSR goes up, then the net worth requirement goes up, and you may or may not hit it. That's why it's so important to nail that TDSR right out the chute. So if you're interviewing these customers, start getting everything ready. Get your tax. If you own 2-3 other properties, you got rental properties, then I want your T1 gens with their real estate rent in there, all that kind of stuff, because it's not unusual for people to have this net worth liquid asset like this to also own other properties. And this program allows them to buy more of them. It doesn't seem to be any cap on it. It's the net worth that required is the most important to know that they have ability to make their obligations based on their assets. So yeah, that's a good question.
I just have a quick question, Terry. You had mentioned doesn't seem to be any cap on it. Does that go towards the TDSR ratios as well?
Yeah, I had 500 something TDSR once, but they had millions and millions of dollars, so it didn't really matter. I think the net worth came to 2 point something million required. They had that, no problem. So it's just sort of frustrating because you don't know 100%, and that's why I always like to make that point of there's borderline. And then if you look at statements, holy geez, you're only looking for 400,000 on mortgage. TDSR is only 60-something%, and you have $4 million. Then unless something weird shows up on a bureau or whatever, disqualifying it. Those are pretty much shoo-ins, and but it's the tight ones. It's the ones that are and that's where you need to see their statements, and you want to get as much current statements as possible. March has already passed, so everybody should have their March 31st by now and their quarterly statements. So that's what I like about this time of year. It's a little closer to the quarterly statement and looking for that accuracy. But yeah.
Okay, and then the other thing is I did notice in there it said step eligible, so you can do mortgage Heloc with this product as well. Yep, absolutely.
Yeah, so go ahead.
That MoMA calculator, is that still something we could use as a guideline, or can we not trust it as much now?
Well, the one I sent you one, or did I send you it? Yeah. And it's you can see it's internal because it talks about other parts of the applications the broker doesn't see. So plucking that info, you may or may not get the right amount in because but if you follow it, it should be pretty close. Yeah, it's one of those things where it has to match what I see in my screen, but you can pretty much add up everything yourself and take a look. My system shows me that number of, say, the total payments a year come to 40-something thousand. It tells me that number. I don't have to add it up myself, but I think that's something that you'd have to do independently. And you got to factor in the qualifying rate. That's where it's like, and I think the rate is on there too, if I'm not mistaken. So it ended up, you may get a vague answer. It's just something that I wish we had on our website. You just plug it in. But I think sometimes you miss a number and you quote that to the client, then I get the deal. I get a different answer. It's like, whoops. So I would always wait to see. But the borderline, sometimes give me a buzz. If you're looking at assets and you're not 100% sure, send me an email saying, listen, would this fit? And those are the borderline deals, Yeah.
Okay.
Anything else?
I guess we just have to try it when we get one.
Yeah, well, that's the thing. But once you get a couple, you sort of get the flow, and it's just like anything else. When something new comes up, it's a little vague. It's tricky to explain to a client, but like I said, when you have major holdings, it's generally not going to be an issue. But except for that holding company, because I saw they had I don't know how many millions, lots. And I was disappointed I couldn't get that done, but I'm the one that didn't notice the articles had multiple shareholders on it, and the risk department did. So it's good and that's why every one of these deals need to be signed off by a risk manager, because I don't have the authority to issue commitments on those programs. Even if the TDSR goes up a basis point, It's like, oh no. And that's why sometimes on these programs, when you see T1 generals, and let's say you're using T4 income, then you go to the bottom of the T1 general and you see, oh, well, the T4 income is from 3 different companies and he doesn't work for 2 of them. You get that T1 general after the fact because you think you saw the proof of income statement. Oh, okay, no problem. Then you get that sucker. It's like, darn it. Then I got to recalculate my numbers. Then I got to send it back in. And hopefully sometimes, it's still okay to make the deal work. It's just one of those things where I need to be right on the first try. That way they don't have to go beg the risk to change their numbers. So it's one of those programs where you got to be dead on. But if you're not sure and you're going to send one in, sometimes it's good to go over it, and see what they have.
I've done a couple. I just wanted to give feedback. I've got 2 in the pipeline right now, Terry, that ended up with Gazelle because I needed to secure the rate before it changed. And I think there was just a couple days. Anyways, I was disappointed I didn't get to work with you on that one, but we have 2 and they're closing. So
good.
It's good. Yeah. We needed 800 on one, and I think we could, she worked really hard and got us 790, which was close enough for the clients. So and then we had another one, remember with the UK transfers and all that, the clients,
yes.
We were so close, but the clients ended up walking away. But it's a challenging program, but I do like its flexibility for sure.
Oh, for sure. And it's got to be weird for a client who has high net worth and the bank's humming and hawing to lend them money. It's got to be hard for them to understand that. It's like, I don't understand this. I have, like $1 million with the bank, but yet, I can't get the mortgage amount. This isn't the old days. When I first started, the manager would just simply sign off on it. It was like, done, so that type of lending is a dinosaur. The good old days where you can just look at financials and take the gross and not the net, but you looked at other parts of the deal to mitigate the risk. But this mitigates risk really well. If you notice, every single one we don't have a stated income, like and up in the old days of just stating income. The closest thing we have to stated income is the Business for Self Plus program. So if you ever get a deal where you look at the TFSR and it's over 44%, and you're looking through you got the calculation from their T1 generals, get the financials. As long as they're prepared by a CA, then you can go by and see the net income. But that's another program where you're really not going to know the answer until I'm done calculating it, because the net income after tax, there's 2 calculations. You can do 60% or 40% of it, depends on their credit rating. So you may say, hey, they got a 700 beacon, and all of a sudden it comes in lower on my end because it throws a TransUnion in there, comes up with combined risk score, comes in lower, then we can do less income. So it's a crapshoot. But if you see like beacons of 700 and something plus, you're probably going to be okay, generally, historically speaking. But this program's been something that I'm getting a little bit more of, and especially in those deals. If you look, hey, you can't qualify, get your financials and look at them. And then if you're not 100% sure, maybe send me a quick copy and I'll take a peek at it. Of course, this is the one where it almost works like a 2-year average. You take the lower of the 2 years and times it by your net, and then hopefully. Sometimes I have nothing I can use. But most of the times I can use some income off of there. So that's a weapon for you for those tight deals where you're like, okay, we're going over, get the financials anyways, because I love that. I can change the program and go in and use that income. That's also another program that has to be signed off by risk adjudicators because of the nature of not using the income. The government's been very, very strict about us using some income. They want some TDSR calculated. There's no more 0% as far as the banks are regulated to lend by. There's always got to be some source of income coming in. That's been very important for OSFI, and we have no choice but to adhere that. These programs help with that. Do we have time for me to go over the Business for Self Plus real quick?
Yeah, for sure. All
right. So this is another one here. It says self-employed customers with moderate personal income who have income in their operating companies. So that's it's typical not to declare all your income yourself, so it's perfect. You can have primary residence, vacation homes, rentals. So that's pretty cool. STEP eligibility, yes. So that's another good feature. The borrower eligibility, this is very, very specific. Okay. So customers who own an incorporated business with significant amount of net income after tax in their business, that can be accessed. Canadian residents, including permanent status, paying taxes in Canada. So no foreign or nothing applies to them, or start right or 900 cents. Business must be registered in Canada and pay Canadian taxes. Business entity must be 100% owned by the borrower. So if you have like a brother owns shop with other brother, then that one guy can't buy a house by himself. And there's no co-signers on these types of deals. We have multiple borrowers, and sometimes the third borrower has to use this income for all three to qualify. So that's not unusual, right? So don't get scared off like that. If something like that, there's eligibility as long as they're all buying the property, together. That's cool. Let's see, where to go here. Personal income, of course, you got your T1 generals. So the income's going to be in two spots. We put whatever's under T1 generals in as business for self-income. Then I have another spot where I put the net income after tax. Let's pretend it's $60,000. That's going to go into the income. I don't tick the income box. What it's going to do is it's going to calculate TFSR based off of whatever their income they're qualifying at. But I do a manual calculation to show, hey, TFSR is more like 37% if you factor that 60, not 75% if using that. So I sort of need to break that down for them. Again, if it's not on T1 general, we can't put it as income, but we can note it as available to them. Is what we know that they have that money in case they need it. Foreign income sources not eligible. RSP withdrawals are not eligible. That's not eligible for any type of income anyways. Business and proof of ownership. Of course, 2 years of signed professional account prepared financial statements, including the notice to reader and including compliance engagement for fiscal periods ending December 14th, 2021. That is new. Financial statements have changed a bit. Okay, so if it doesn't have those on there, then we won't be able to do the deal. So that is a very important part to keep in note. And of course, you can't expect that for any years before that, but starting December 14th, 2021, expect to see those on there. Must show
Terry,
positive. Oh, go ahead.
Sorry to interrupt. Compilation engagements. Are you just talking about like tabulation of income and expenses up to date? Okay, thank you.
That's right. Yeah, that's right. Most show positive income in all years. So if you see negative, obviously, we can't put that in there. Eligible income is lesser than the two average. Same thing as regular income. So if you take your two Nates and one's 80,000 and the 160, then if it's the 60 is the most recent, then we use 60,000 times whatever calculation we're eligible to use. Confirmation of business activities to help identify level of risk. Now, these next ones, it says, what does the company do? What industry is the company? For how long has it company been in business? And these ask how many. Usually it says how many employees you have, but they don't seem to have that anymore. So you want to give us a good rundown of the business. So when you see this business income and proof of ownership, if you look down to what the company do, just sort of put that in your FileLogix notes and just say, or whatever you're sending in notes, and just sort of break it down, because sometimes I get deals that says self-employed and there's nothing. So I have nothing to explain in my notes, and that's vital to this adjudication. Is what does the business do? It doesn't matter what they do, as long as you answer those questions. Questions asked the customer and must be the submission notes. Provide a clear understanding and detail of the customer's full financial picture, including business activities. Submission notes to include confirmation that the applicant and the business are not on the prohibited business lists. Obviously, if you're doing something illegal. Include information on how the customer will make the mortgage payments in excess that would approve based on verified income. So when you see the financials, or you see they have lots of money in their bank accounts and stuff like that, we want to comment on those types of things. But generally, I have a pretty decent approval rating on these programs as well. And it's because the brokers are submitting more and more of them to get more used to doing it. So what I provided you guys here, and I always title, when I send you, I'll make an attempt, when I send out stuff like this, I'll try to put the date in the email line. So, as of this date, this was the policy. So if you're doing another one of these a year and a half from now, maybe you want to go to the website and see if there's anything that's changed on it. Or if there's any policy changes, I'll do my best to try to say, here it is as of this date. That way you can see the most current and what it is to help you guys be able to dig through. I don't know if you guys do this, but I suggest having a folder, for Scotiabank, in your emails. And if you want to break it down by just BNS or break it down by program, and that way, when you go to do one, you can search back, oh, okay, here it is, and give yourself a good refresher, because I think this provides a pretty good information from the website, but I think it's a little bit more detail to sort of explain why is he asking for this, or why the bank need to know that, you know, then you guys are a little bit better prepared to answer those questions.
So I've got a client, in fact, he just approved him on an extension on his line of credit, but I was looking at his financial statements and he had a net loss, not much, in 2019 and a big gain in 2020.
Mm-hmm.
And so, you know, I would look at it and say, okay, good. What are his retained earnings? Now, in this case, his retained earnings are still well over 600,000. So, you know, I would expect that you would be looking at that and mitigating it. You know, is COVID, not COVID, you know, all that kind of crap goes along with it.
Yeah.
It's nice to have those big numbers, but when we get into smaller businesses and with the smaller things, if we saw a negative on one year and a positive on the other, retained earnings would be another aspect that you would look at to try and mitigate it, or would it be just, oh, we don't have 2 years positive, don't even bother?
That's the thing, you know, that's where the tricky part about this is. We want to make sure that the business is stable enough, because we're using income that's basically in a financial statement, you know, that could change on a dime. Retained earnings are one of those things where they take a snapshot. Here's your earnings today. It may not be that in a couple months. It could be different. You can take out a big loan and stuff like that. So we don't know. We're sort of hedging our bets that this is what the financial picture looks like today. Retained earnings can always be noted in a deal. You know, we may not use the business for sale program and just get a TFSR exception anyway, saying, listen, retained earnings have this, business bank accounts have that much money in there, whatever, solely owned by the applicant. You know, when it comes to conventional deals, except for specialty deals, you know, and bankruptcies, there's always wiggle room, you know, to be able to explain it in the what risk wants to hear. Their name is ACE. You probably heard their name ACE before, but what they want is a clear, concise way. How are they affording the payment? How do they do that? I need to explain that to them. Notes is vital. Another thing I find helpful for my brokers is that if you get your newer applicants and they only been on a job a couple months, and you sort of want to spice up, well, where did they go to university? What did they study? You know, and because when you're making exceptions on income like that, for example, it's important to say, well, tell me about yourself a little bit, because I was my bachelor in commerce or something like that. It helps me when I put my note, because it sort of gives a picture. This person went to university. They got the first job, find there's probation, or find there's some kind of casual note to it or whatever that I may want to get an income description on. We sort of want to bulk up them as the applicant. And I find that's really helpful. You know, hey, they studied engineering and whatever. The second the bank hears those professions or those studies, it gives a better picture of and a little bit more comfort level when they go to adjudicate making an income exception. You know, and sometimes I see applications where it has previous income. Try to do your best to fill the incomes in, because even though they work there and they don't work there anymore, just put the incomes in there. So if I make an exception, hey, the guy earned, I don't really need verification of that unless it's specified that I want to see that. But I say, listen, the guy earned 100 grand his previous employer, you know, 100 grand before that, and so, you know, so the income is consistent, and it's vital for me to do that. So when I go to risk, I get an answer fairly quickly. I find I do talk to the risk guys a lot. Say, you know, what do you know, how do you like my submissions? The way I write my deals up, it's like a book. I just title purchase, you know, and it give a big story, and it's required in all my deals. That's what takes me a little longer than to write a deal, because I'm pretty much typing up. So someone who can read my notes can understand the entire deal without seeing the mortgage act. That's how detailed my notes are, and I've been doing it the same way for 24 years now. Because I don't like making mistakes. If I make mistakes, it costs me, you know. So it's one of those things where we have to be perfect. I have to be perfect on 100% of my files, you know, and I have been, you know. So you guys do a lot of work that helps me get it through. I'm really happy I got you guys as a team, because you're already seasoned. You already have Scotia exposure. You're not brand new, and you know we spend most of our time trying to train. You know, so it's that helps me get you faster answers as well. So you guys do a great job. I really appreciate all the stuff you do for me, and hopefully I'll be in the Okanagan if they let us, and then we'll all go up and do something, because I know we like to go to Soyuz. That's where we got married, so we like to go to the Okanagan, that family there. So hopefully this year or next year or whenever I'll be able to get off this island and see you guys in person.
That'd be great. So I had a question also on that same file. first time I've seen this where you wanted to see demonstration the business is still in effect, even though I sent you financial statements. It's the first time I've seen that, okay, send me bank statements or send me proof of GST, and there was some other consideration. I've never seen that requirement before. Now, has that got something to do with the fact that I don't have the most current financial statements, or is that an ongoing thing that we need to ask for from here on in?
That's a fairly new policy. It's been around probably about 6 months. But I hate it. I hate it because the sole proprietors, it's so hard for them to verify, because a lot of their business bank accounts are personal accounts that they don't say business on there. And you can see, sometimes you can see transactions in it that look like business transactions. Some are just e-transfers. So you can tell there's a business operating there. And I find in those cases, you might want to see if you get a couple invoices to match the deposits. Hey, this one came from whatever. But yeah, you're right, because I have a massage therapist. They just get e-transfers. They don't get a bill. There's nothing on there, so it gets really tricky to verify sole proprietors. But that one, I hope that goes away soon. I saw that, I'm like, oh goodness sakes, it's not enough that we ask for articles and financials and T1 gens. It's like, I think, yes, you want to make sure, especially with COVID, I think it affected a lot of small businesses. I'm sure got affected by COVID more than anybody else. And I think what they want to make sure is that has not screwed them up. You don't see much happening this year, then hey, something's up, So, but you always, those are conversations you want to have with your clients. How's it going? How's business running? Oh, okay, good. Got a new contract, great. Things look a little iffy, but now the guy's back on track. And those are types of conversations that you have that are vital to me, anyways. That you spoke to them in depth. You got a good idea what they do for their business. They got contracts. Especially a lot of people where you can't Google them. They're not going to have a business. They don't have a business address. They don't even have a business phone number. They're contractors. They're consultants. They're not going to have too much of an online presence except for LinkedIn. I find that someone's not on LinkedIn, that may be a little bit of a red flag, but it depends. They might be a plumber and 70 years old. I'm not on LinkedIn. The guy's just a plumber. Gets contracts or whatever, just explain that, private contractor consulting. Because if you see, the first thing I do, anybody who's self-employed, if I'm not sure if it's a clear business that I'd recognize, I Google them and say, oh, okay, so I can put my notes. So especially LinkedIn is very handy, because people love to butter themselves up on LinkedIn. It looks great for my notes, so that way risk has, oh, okay, the guy does this. Oh, great, so it's really good for them to get that. And those are all one of those deals that you're not sure about the income, or you want an exception on income, or credit's a little thin, little things like that. Don't be afraid, especially if there's some credit challenges, as long as there's not obvious collections and super recent bad delinquency. But if there's like R3s and R4s that happened a couple of years ago, just say that my banker doesn't care. My guy at Scotiabank is not going to judge you on an R4 or R3s or even a written off. What happened? And that's all I care. If you can tell, that they don't feel like making their payments, they're that type of person, then well, I can't push your deal if you're not going to give me something. But most people I find do like to make their payments. But something bad happened. I lost my job, or you might see some pockets of delinquency with COVID. You don't, and it's all you need to do is explain. We still use 3-year averages if COVID affected one of those years, right? So if he had high income in 18, high income in 2019, then nosedive in 2020, then okay, we're okay to use 18. We have to throw 2020 in there, but it might be the difference. So if you see that really bad 2020 or 21, okay, get more years.
So is that, are we seeing more of that income requirement through OFC as well? I mean, I just ran into that with a reverse mortgage application, and the amount of information they wanted on their business. Yep. Granted, they're 70 years old, but still, the amount of business they wanted, bank statements, they wanted invoices. I thought for a reverse mortgage, that was really weird.
I didn't think you needed anything.
Well, and so that's my question, is OFC leaning on lenders for all of this stuff? Okay.
The government's been pretty, ever since 2008, everybody remembers that disaster. We used to have Scotia Mortgage Authority used to be, we bought that name off our B lender. We used to call Scotia Mortgage Authority as for the B lender type deals. And the second that this issue happened in the States, the bank just chopped that right off, just dealing with regular customers as opposed to we just dropped the B lending altogether, but because of that. So ever since then, the government of Canada And I think it's been very noble because we could have a lot of problems, if we lent the way we did in the United States, for example, predatory lending or doing what's not right for the client has been a normal occurrence in Canada. The banks have fared way better than any other banks in the world. Didn't need much stimulus to get back on their feet, is a testament, I think, of our underwriting. I'm sure Scotia, we got to have the cleanest book of them all. So as far as I'm concerned, we got the best customers coming into the bank, that may help us build, our portfolio with them and keep a customer relationship going, with the leads that you guys give us. So that is greatly appreciated. And I think it's the tough rules, I think, paid off really well. Brokers are used to it now. There's no more, okay, could you just make an exception for no reason because the down payment's big? Those days are gone. If there's reasonability, part of my notes is what's called a down payment reasonability that OSFI will actually read, that explain. So-and-so is 39 years old, earns 200 grand a year, has been at the same job for 9 years, saving $100,000 is reasonable. Like they expect a note like that to be there. If someone's young and they got $200,000 in their bank account, that's something that you need to address with them to say, listen, it's unusual for someone that your age to have this money, and 9 out of 10 times it's an inheritance of some kind or a gift of some kind. So, I knew a girl who's been saving money since she was 12 years old to buy a home. She just wanted her own home, and she saved money since she was a kid, and she's 25 years old, and she had $80,000 in her bank account. Asked the broker, was a scoop, and that's what she said. Is it unreasonable? Absolutely not. Because it makes sense. So something that may look funny may make sense once you clarify that. And always rest assured with your clients that your guy at Scotia has been doing this for 24 years. I try to find the best solution, to try to find a solution with you guys to make most deals work. But let them know, like, don't be too scared if there's some late payments, or don't be too scared if you're on probation. Tell me about yourself. What do you got for education background? Or you got all this money. Oh, some people just come from wealthy families. Simple as that. And that's what you put in your notes. That way, when OSFI looks at our deals, we know that we're making the right decisions. We're not going to put any customer in jeopardy. We're certainly not put Scotiabank in jeopardy. And of course, the government has to change their policies if things get really bad. We realize that half the population can't afford the mortgage payments because we use the qualifying rate. We didn't use the qualifying rate. We use the whatever rate they're paying. I think that 2% spread's vital to show that you can afford an increase. So to me, it's tough medicine, but it's the right thing.
What's happening on the high ratio side? Any other guidelines coming down on, or changes you expect in terms of policy? Or
I was third in the country with high ratio mortgages, and now it's if I get one every 3 weeks, it's all conventional here. What a switch it has been from Alberta to here, with because of the $1 million cap for insuring. I think there's word they may increase that. I don't know to what. I think it used to be 1.5 a long time ago, where you can put 5% down. But I think the 1 million is unrealistic now. If you're going to build, I think 10% would be reasonable to ask, as opposed to maybe 20, for anything over $1 million. But I know that's floating around. I know that our variable rate, the credit unions are out there with some very aggressive pricing. And our pricing model is very delicate here because, where we pay a lot of commission to two people. and so it's very expensive to not to want to jump and offer that, So this is the time of year credit unions buy the paper. They're simply doing that. First Nat apparently has a pretty aggressive variable. I made my boss aware of that. So national sales does know they'll know. John Webster is not going to sit there and not have mortgages come in because we're so far off rate, so I know they're working to maybe come up with something. Scotia always comes up with something, it's not as busy as last year, but we still have business to get. The sharks are in the tank now. When it gets slower, everybody's fighting for those deals, and the only weapon that we have is our service. That's it. All the rate, we have a good rate, you get the people in the door, but if you're gonna wait 2 weeks for an answer, they're going to pay more on the rate if they have to go somewhere else. And I've gotten deals because TD for some reason 2 weeks, Royal Bank 2 weeks. I'm not sure what 2 weeks on earth. Why? I know I write more mortgages than they do. It doesn't take me 2 weeks to get a deal done. So, you like clients, yeah, that rate's pretty attractive. However, you haven't heard back from them in a week. So what do you want? You pay a little bit more. It's too bad that they have to do that. So my job as a BRM is I'm also the underwriter. I'm not a BDM that hopes the underwriter is going to get the deals done, because they're at the mercy of the underwriter. You can sell all the rates and all the special programs in the world. It's the underwriter that's going to get you those answers. And the BDM can email them and hound them all we want to try to get the deals done. I know my capacity limits. I know, hey, can I squeeze a couple more deals in today? Yeah, I can get that done for you. So that's the, I think there's a benefit there. So if customers are looking at rates and you're talking about service wins all the time. And I'm glad we were able to provide that. We did 40 billion last year, 40 billion, 42 billion. That's crazy amount of 130, 29, 25 underwriters. That's a ridiculous amount, unforeseeable amount of mortgages. People had 40 in their queue, 60 deals in their queue last year. It was crazy, but the brokers still kept on sending it to us because we're the ones that still had the best turnaround. But for some reason, we write the most mortgages. How's that possible? So we have a pretty good system. Yeah, we're pretty strict, as you know. Sometimes there's just no wiggle room, but a lot of times I think we know how to get it done. And yeah.
Terry, I think
last question for me is micro suites, insured mortgage micro suite in Kelowna. Is that something I could throw at you?
No, not at this point. Even though some insurers may do those, Scotia is still pretty strict with you can have like under 500 square feet, but it has to be in a very marketable area. Like downtown Vancouver, I would consider, downtown Toronto, I would consider, because it's just the market there's there to support it. Where a long time ago, it wasn't. Remember, condos were sort of like funny. They're going up and down. They're the ones that swing the most in value. But now I don't think it matters until, and we're going to see more condos being built, and some of them may be really small. To be able to at least, if you're a single person, you don't need much space, maybe you could fit in 350 square feet. Maybe that might become normal. You never know. We have to go with the times. And as long as the marketability there, that's the most important thing the bank wants to know. That 300 square foot is tougher to sell than not. But maybe
this one would be probably 380 square feet downtown Kelowna. So would that be a possible, or is that a no?
I would say no, because it's not in Vancouver. That might be too small for Vancouver, but I don't know. I know that I couldn't get them done under 400 square feet if they're not in Vancouver. Yeah, that has been pretty firm. But it all depends. If there's a sales rep there to say, yeah, Scotia's done some of these already, and make sure they're the size units. Because I got in an argument with a broker one time where it's like, well, you said Scotia wouldn't do it. It's like, yeah, they did it, but it was for 800 square foot, not 300 square foot. So the broker got the wrong message from the rep. So if Scotia is financing the building, say, listen, do you know if some units under 400 are being financed by Scotia? And maybe I can find them in my system, because sometimes if I put the postal code in, I'm able to find the addresses that are under that postal code and see, oh yeah, Scotia has done some exceptions on them. But if you want my answer, what I think, it probably be no. But it's nothing that I don't think Scotia may consider going forward, because that's the only way we might solve the housing crisis, is by having way more townhouses, way more condos. You can't afford a single family dwelling. A lot of people can't, but you may have to afford these things, and the banks may say, hey, they're still good investments. So for now, I would say, yeah. Okay, go ahead.
Apparently TD did the deal, but there's underwriting issues, and I haven't seen the deal yet, but it's an insured mortgage. That's all I know. And I didn't know that TD did micro suites. All I know, and I haven't got the detail yet. So
yeah,
maybe when I get more stuff, I won't bother you more on it now, but it'd be nice to kick TD's ass on this one if I can do it.
Well, that's the thing, because we have other BRMs that do work in Kelowna, right? And maybe I might shoot them off an email saying, you guys finance in this place? Yeah, but does it sound familiar? So send me it, and I'll flip it off to Dean, my guy there in the interior. Maybe he's done some. You never know.
All righty, I get.
All right, man.
So Terry, you may not know the answer to this, because I think it's more of a branch question, but we've seen,
set me up.
we've seen the last little bit. There's been a lot of calls from the branch. I assume it's from the branch. Maybe it's from telephone banking, to clients who have variable rate mortgages, and they're talking about fixing those variable rate mortgages, which to me, I'm I think we're pretty good with letting our clients know that if they're worried about it, just let us know. So we get a lot of the calls after the fact, but it's just something that's become very common. Like in the last 2 days, I've had 2 calls.
Yeah. Oh, sure. You know, people would rather fix it, you know, because if I'm not, I think the branch, I don't quote me, but I think they can give a pretty good discount off the 5-year fixed, you know, especially if they have these value packages that do have some quirks that maybe they might build a port them. So always tell your client, double check your rate and your terms on anything that you take as a rate. Because if it's a value package mortgage that the branch could offer to flip that VRM into a fixed, let them know that. Some of them aren't portable. The maximum prepayment is 10%. They're not killers, but they could affect if they decide to turn around and buy in 2 years and find out they can't port. So
for sure.
Yeah.
And it's just a really interesting note that, you know, that the branches or whoever is making these calls are being a lot more aggressive with kind of that. I call it a little bit of fear mongering, because they're really like, oh, you should really try to hedge your bets. And it's like, well, we've had this discussion with the client.
Depends what the experience is. And you know, if that person at the bank is working there 20 years and does a lot of mortgages, you can explain it to the client. But if you have someone that's new, they might say, oh, we're going to panic and put that, you know, and that's where you guys come in. You're as professionals, you understand VRMs, you get, you know, all those little things in the background. You're probably gonna get a lot of inquiries. Funny thing, I've been amending mortgages, but I've been amending them from fixed to VRM. So I'm not sure what to make. I think some people are still comfortable with it. The fact that it's not a killer interest rate, especially if people had mortgages in the 90s, you know, we'll get that, you know, but yeah, you're right. We're probably going to see, I have a VRM, you know, and one part of me think, damn, I should have fixed that sucker because the rates are so low. But you know what? Yeah, it's still good. I still got a very good rate, you know. So to me, it's still value. Unless somehow prime goes up to 5%, then you're like, oh, great, now we're way off here.
But even at that, you're probably still prime -1, so you're still as good as today's fixed rate.
Absolutely. So yeah, as long as they're always cool with that, it's just the customers, you know, in the end, don't do this the way we do. It's not like they're dumb, they don't get it. That's not part of their lives. You know, they don't see this, and a lot of them take it for granted that, hey, I got a good rate, and then you look at your term, oh, that was only good. That was only for the first 9 months, and now your rate's going to change here. So it's like it's those things where always go to a broker. Like I cannot stress. It sounds weird, and I'm plugging you guys, but it's obvious. See a professional. And don't go for someone that's going to shoot rates and only rates.
Exactly.
And they don't get back to you, and they're not calling you back or whatever. Nothing would frustrate me more, a customer, than my mortgage broker not get a hold of me, because, you know, they're antsy. You know, even though they may qualify for mortgage and you know they qualify, there's always that question mark. How come I didn't hear back from the bank? What's going on? You know, and yeah, that's what I'm hoping to accomplish. And I got a couple purchases today that I hope to get out before the weekend. So the broker's like, oh, look at that, I got my mortgage before the weekend. So yeah.
Given that we're always under time pressure, I'll be really brief. I got 2 other points. Point 1 is July 20th, we will be having an open house, and you're absolutely invited to come to the open house. We haven't really formally announced it yet, but it's coming. Okay. So if you can plan a trip here, we'll definitely love to have you here.
Well, I hope the bank would make it worth my while. What day of the week is that?
It's probably a Wednesday, I think.
Okay. Oh yeah, so we'll send me the dates, and then or whatever, and then we'll see if they can swing something to let me pay for my flight. Probably not. We'll see.
You never know. But probably cheaper than driving.
I know. I would love to. Yeah, I'd love to see you guys, and I know I'm gonna. It's just it's tricky. And I just kind of live on the island. There's always that extra step involved with me traveling now. Yeah.
Okay. Last point. So you like stories. So does it help if we say the client loves Harry Potter or Nintendo?
If he works for Paramount or Nintendo, I always get excited. See ETA Sports, like, cool, nice job, man. You know, the guy tastes video games. That's what his job was. He tested video games. Unbelievable. Sweet. Yeah, sweet.
Every kid's dream, right?
Exactly. Yeah, you know, the customer can be whoever they are, as long as they qualify. It doesn't matter to me. And that's what I always emphasize. You know, like throw around my experience. I got a guy who's been doing this a long time. Let me pass by him. You know, and if they're always go run to their cousin or go to their brother-in-law for a better rate, you know, yeah, good for you if it works out. But the customer experience, you know, is very important to me. You know, when I underwrite deals, I don't know if you ever meet a client, you always picture what they look like in your mind when you're underwriting deals. You see, oh, they're a nurse. You picture a nurse, and the guy works on pipeline. You picture the client, and I always feel for them if they don't get their keys on time. You know, and I've so far, knock on wood, never missed a closing date yet in my entire career. So, you know, refis always get pushed for whatever reason, but purchases are I'm on it. My funder emailed me, say, listen, we're still missing conditions. I try to catch those, but sometimes I don't. And it's like, whoops. And then I'm on it. But my own priority is to make sure that they're not going to be standing there without their keys, because with all due respect, they're going to go to you.
Yeah, for sure.
And not me. Yeah.
So best way to get a hold of you, if any one of the brokers needs to get a hold of you, is email always the best?
Just email me. It depends what it is. Some people have a scenario. Hey, Terry, got this deal, whatever. Or do you have 5 minutes to call? And then, yeah. Email me. They're always my reminders, okay, I got to email that person when I'm done this deal or whatever. Yeah.
Perfect.
Absolutely.
Awesome. So thank you for your time, Terry. Really appreciate it, and appreciate the insights. If you didn't receive Terry's emails, let me know, because I did get both, and I did put them on the screen. So yeah, if anyone has any questions, there's Terry. You let me know if you need any other things, and otherwise, yeah, we'll carry on.
Awesome. Great time.
Have a great
Thanks,
weekend,
Terry.
Oh, anytime, guys. Thank you so much. Thank you for the business. Appreciate it.
Absolutely.
All right.